So, big Fed meeting tomorrow. I mentioned it in yesterday's email, and I've been getting a lot of questions about how come we're not in the XIV, because for over a year now I've been talking about how normalizing interest rates is going to be a good thing for the economy. And if that's going to be a good thing, then wouldn't that mean that we're going to make money in the XIV? Well, the way that I would answer this is, first of all, I do believe that normalizing interest rates will be a net positive. Of course, there's going to be negatives that come about. No policy is ever really clean, but on a basic cost-benefit analysis, I do believe that normalizing rates is a good thing. And I think they're a little bit too late. They should have started a couple of years ago, but better late than never. However, the strategy, of course, doesn't take into account my own personal predictions. It is just based on the signals that I track and the mathematics underlying the markets. So fortunately, in this time around, I don't actually have to make any decisions because the signals themselves are flashing cash, right? The volatility metrics are flashing a yellow flag there. So we are in cash for the reason that the signals are saying that. But even if they weren't, for just that one day tomorrow, even if the signal was to be in the XIV, I would still prefer to move to cash because it's never a good idea to trade global macro events. And the reason for this, of course, is because risk and potential for gains and losses in the very short run, we're talking about 1 or 2 day periods, it's not equal. Okay, so risk is asymmetric to the downside. You can lose a lot more money to the downside over a 1 to 2 day period than you can gain money on the upside. So whenever you have these type of events like an election, like the Trump election, the Brexit vote, Fed meetings, very long anticipated jobs reports, or some type of all the global macro events that can move the markets, the number of times that you have to be right in your prediction has to be 2 or 3 times as often as how much you're wrong, because the wrong is when you really get caught. Remember the Brexit vote, just as an example. The XIV the next day was actually down 26.7%, biggest crash in history. Now, the largest XIV gain in history is only 13%, so that's double. The gain is half as much as the potential loss. And the stock market is the same. The biggest gains are far smaller than the potential losses that you could suffer. So I just prefer to be in cash, and fortunately this time around the signals are also in agreement with me. But you can remember last December, for many of you would remember that we were in cash during that Fed meeting as well, when the Fed did actually raise rates for the first time in a very long time. So it's a global macro event. It can move the markets, and fortunately we're in cash. I like the fact that we're in cash. And we'll pick up the signals, Thursday. We'll see what the market tells us, and we're not going to get caught. That does mean that we would potentially be giving up some upside. But again, I don't care about that. I've demonstrated, time and again over the years that I'm really not in this to try to make money. The sole purpose of the strategy, because it inherently is profitable, the sole purpose is just to add layers of risk management to try to reduce the drawdowns. And avoiding major global macro events is one layer of risk management. So it's a good thing. But I actually have a different question for today's video. So let me get into that one right now. Okay, so this morning I've been watching the numbers on the web, and I was thinking of using leverage on the strategy. Providing that the win rate is 80% and the max drawdown was 29.8, using, say, 2-to-1 leverage, you would double all trades with the max drawdown being 59.6. So to recover your losses, you would need a 147.5%, but also your best month would go from 37 to 74%. And knowing that you win on 80% of the trades, I don't really know if it would be better or worse. What do you think? So the very short answer, and then I'll elaborate a little bit more later on, but the very short answer is no. Don't ever margin, don't ever leverage anything ever. Okay, it doesn't matter what if you're up 80% win rate and you're down 20% loss. No margin. What if it's a bull market and you're expecting great returns going forward? No margin. If a trading strategy requires margin to be successful, it isn't worth trading. Okay, this should be one of those rules that's pretty much at the top of your list. Rules that you never ever break. No matter what your mind is talking you into, no matter how much money you've made on a strategy, that is a rule that you should never break. Okay, bad things happen when you break trading rules, and that's one of them. Don't leverage anything ever. The only time that you can realistically talk about leverage is if you actually had some type of arbitrage advantage, some mathematical edge in the market where it wasn't dependent on your edge in trading, it wasn't dependent on your knowledge of markets, it was literally just a mathematical edge. For example, high frequency trading is sometimes based on the fact that in large volume purchases and negotiated contracts. They can get cheaper premiums on trade fees and whatnot and commissions. And if that's the case, if that's where the market is, if that's where the edge is coming from, then maybe you could make a case for taking margin. But in any and all circumstances regarding you and I, just retail traders, absolutely not. Don't ever do it. So this really gets to the heart of having realistic expectations. So let's take a look really quickly at what that means. Okay, so this is a very basic S&P 500 return calculator. And just so we know what realistic returns are, we're going to take 1996 to 2016 November, and we're going to take a 20-year annualized rate of return of the S&P 500. Now, nominally speaking, we're talking about a 5.5% rate of return. Even if you were to get into a dividend reinvestment plan, which is a good idea if you're just going to be a buy and hold investor, by the way, but even if you were to do that, it's only 7.5%. But the nominal rate, the index that everybody's trying to beat, is only 5.5% over the last 20 years. Now, you also have to remember, keep in mind, over 85% of the financial industry is underperforming this number. So, I mean, more or less, that's not an exact figure, but roughly 85% are not even getting 5.5% return. So again, with realistic expectations, is there something wrong with the 71% that we've achieved this year, or the 78% that we achieved last year and going back, etc.? The balance strategy, for example, that's up over 20% this year. Is there something wrong with that one? You wouldn't want to leverage that either, I hope. This is very good returns, and we should just basically trust the strategy, and we shouldn't even consider breaking that number one trade rule of no margin, no leverage, ever. Another reason that you should never margin is something that you kind of glossed over a little bit in the middle of that sentence. But your math was dead on, by the way. You know, you're right. You definitely know what you're talking about, that if you double your rate of return, you double your drawdowns, and you actually need a substantial recovery afterwards. You know, if you draw down 59.6% today, you need a lot more than 59.6 gains in the future to recover. You're right. You need 147.5% return. So that's significant in itself, that losses are always far more costly to a fund than gains are beneficial. You have to be very careful about not taking excessive losses. But the part that you kind of glossed over there is the 59.6% drawdown. Now, obviously, everybody has different levels of risk tolerance. I can't actually tell you how much is your limit. I feel like I kind of know my own limit. Sometimes we don't until we've reached it, but everybody has a different level of risk tolerance. But put yourself in the position of somebody who has just lost 59.6% of their money. Okay, just really try to feel like, I've been paying for a subscription service, it's been going really well, but for whatever reason, we're now drawn down 59.6%. You've lost 60% of your money. Do you really believe that you're the type of trader that could wake up the next day, continue paying the subscription, and continue taking those trade signals diligently as they come to you? I know personally I couldn't do that. I would definitely feel the need to pull the plug, to stop trading, to try to analyze what's going wrong, to figure things out, and then regroup and come back with a stronger strategy later on. But a 60% drawdown definitely breaches my own personal risk tolerance. So you have to ask yourself, where's yours at? Because one of the things that people forget is that some of the very biggest gains in the market, whether it's stock trading, bonds, gold, real estate, private equity, derivatives, volatility, it doesn't matter what it is. Some of the very biggest gains are immediately following some of the biggest drawdowns. So if you can't sustain that drawdown and stay the course and commit to it, if you're going to pull the plug early, you're not going to be there to get the subsequent recovery. Okay, and I have an actual real example that I can show you to illustrate this. So here we are with the results for the tactical volatility. And as I mentioned in the third quarter performance report just a couple of months ago, while I've not really given anybody any reason over the years to leave my strategies, they've all been very consistent. In June of this year, we were down 20.8%, and I did actually have 2 subscribers unsubscribe and cancel their subscription. So unfortunately, you can see what happened is we've since then recovered over 60%. But of course, if you've canceled and you pulled the plug early, I'm not making any judgments. Everybody has their own level of risk tolerance. But those people did not actually get the benefit of recovering all of that money and going on to make new highs. So you have to be very careful not to look at these drawdown numbers as just cold hard numbers and cold math. It's a lot more than that. So this may sound incredibly obvious when I say it, but another one of those rules is whenever you're applying layers of risk management, don't add more risk to the trades. Right? That sounds obvious, but you'd be amazed at how often people are violating this rule. I see it all the time in derivatives trading, for example. People who are managing trades that are going badly. What they end up doing is inadvertently adding more risk to the trade rather than taking risk off the table. They're basically just picking up pennies in front of the steamroller, and when it goes wrong and then you make an adjustment, we were basically adding more risk, and then it continues to go wrong, you get doubly crushed. And that's basically what we're talking about with leveraging my volatility strategy. It's just not a good idea. You're basically doubling risk and you're not being rewarded on the other end of it because of that potential for panic selling and missing the bounce and all that stuff. So not only am I not trying to get 70% rate of return, I'm always looking for ways to add layers of risk management in the future. So the future returns might be lower, and that's fine with me as long as it's for the purpose of adding risk management and taking off, as many of the bad trades as possible. So you certainly don't need to make 70% a year to retire a millionaire. 15% a year would do it. So, that's basically where I'm coming from as the fund manager. I'm trying to design strategies so that your entire portfolio put together is going to get you to a place where you can retire comfortably as a millionaire, no problem at all. And you certainly don't need, eye-popping 60, 70% returns to do that. So hopefully you're with me on that. Hopefully you understand where I'm coming from. And thanks for the question. For everybody else, ask whatever you want, and we'll do this in the video, and everybody else can take part in it. So see you next time.